Here we are in the latter months of 2025, and I'm observing America's largest technology corporations allocating $400 billion toward AI infrastructure within a single fiscal year. That figure isn't an error, $400 billion. Microsoft, Amazon, Google, Meta, they're all participating in a competition to construct data centers of unprecedented scale. They're acquiring chips as though tomorrow won't arrive, executing agreements valued at hundreds of billions with enterprises lacking established revenue streams. And frankly, I'm experiencing that familiar unsettling sensation I encountered in 1999. You understand, I'm 95 years of age currently, and I've witnessed sufficient market cycles to convey one straightforward reality. When everybody's moving in the identical direction, you should observe what's behind you to determine what's pursuing them, because frequently they're advancing toward a precipice. The AI transformation is genuine. I won't dispute that. However, what's occurring in the markets presently, that's not investing, that's speculation wearing formal business attire. And history tends to discipline speculation regardless of how intelligent the participants believe themselves to be. Allow me to transport you back to 1999. I was positioned in my Omaha office reviewing internet enterprises with zero profits, zero products, and occasionally zero strategies, trading at valuations that would astonish you. Petscom possessed a sock puppet and an aspiration. Webven intended to transform grocery purchasing the globe. Com, initiated by two college students with a 15,000, witnessed its stock surge 6% on the initial trading day. Never mind, they possessed zero revenue. And you understand what everyone declared about me? Warren's lost his abilities. He doesn't comprehend the new economy. The elderly gentleman from Omaha has completed, I recall, one particularly uncomfortable dinner gathering where a young venture capitalist, couldn't have exceeded 30, informed me I was executing the greatest error of my career by avoiding internet stocks. He stated, and I'll perpetually remember this, Warren, this occasion is different. The internet transforms everything. Well, he was partially correct. The internet did transform everything, but it didn't alter the principles of economics. By 2002, the NASDAQ had surrendered 78% of its value. That young VC, I heard he returned to employment at his father's automobile dealership. Now, advanced to today, NVIDIA recently achieved a $5 trillion market capitalization, $5 trillion for a chip manufacturer. OpenAI is valued at $500 billion. That's $500 billion despite reporting only $13 billion in projected revenue for 2025. They've committed to allocating $300 billion with Oracle over 5 years, which indicates they'll need to expend $60 billion annually while generating $13 billion. Even my elementary arithmetic instructor could inform you that mathematics doesn't function. But here's what genuinely concerns me, the circular financing. NVIDIA invests $100 billion in OpenAI. OpenAI reverses and expends that capital purchasing NVIDIA chips. Oracle constructs data centers it hasn't completed yet for money OpenAI hasn't earned yet. This is precisely, and I mean precisely, what we observed in the late 1990s with telecommunications companies. During that era, companies like Global Crossing and Level 3 Communications were deploying fiber optic cable at an extraordinary velocity. They were providing money to their customers to acquire their services. The customers utilized that money to purchase additional capacity. Everyone's stock ascended. Everyone felt like a genius. 4 years after the bubble exploded, 85% to 95% of that fiber was still positioned dark in the ground, completely unutilized. Corning, the world's largest optical fiber producer, witnessed its stock collapse from 100 to 1. I didn't invest in any of those companies, not because I'm intelligent, but because I didn't comprehend how they were going to generate money. My principle has always been straightforward. If I can't comprehend it, I won't invest in it. That's what I designate my circle of competence. And I've expended 70 years remaining inside that circle. You might inquire, but Warren, didn't you miss out on the internet expansion? Certainly did. Amazon, Google, Microsoft, all of them progressed to become giants. And you understand what? I'm acceptable with that because for every Amazon that survived, there were hundreds of pets, comms that didn't. The cemetery of deceased Dotcom companies is populated with investors who thought they were more intelligent than everyone else. Here's the element about bubbles that most individuals don't comprehend. They're constructed on a foundation of truth. The internet was revolutionary. Commerce did transform retail. Cloud computing did modify business. But the question isn't whether the technology is genuine. It's whether the valuations establish sense. In 2000, the NASDAQ achieved a price to earnings ratio of 200. Read that again, 200 times earnings. Today, we're not entirely there yet. The S&P 500 Shiller PE ratio is positioned at approximately 40, approaching the third highest level in 154 years of market history. But here's what concerns me. 80% of the market's gains are concentrated in just a handful of technology stocks. The so-called Magnificent Seven: NVIDIA, Apple, Microsoft, Amazon, Alphabet, Meta, and Tesla. They account for 75% of S&P 500 returns. That's not a market. That's a house of cards. And the data just continues becoming more concerning. According to recent research, AI-related capital expenditures now account for more than half of U.S. GDP growth in the first half of 2025. Let me reiterate that AI spending is the primary driver of economic growth in America right now, not consumer spending, not business investment across multiple sectors, one technology trend. I've witnessed this level of concentration exactly twice before in my life. Once during the Nifty 50 bubble of the early 1970s, when 50 blue chip stocks traded at absurd valuations and everyone thought they could never decline. Then again in 1999 with tech stocks, both occasions ended in tears. The venture capital numbers are even more alarming. Nearly 64% of all U.S. venture capital in the first half of 2025 proceeded to AI companies. For comparison, internet deals only comprised approximately 25% of VC investment at the peak of the dot-com boom. We possess more than 300 AI startups with valuations exceeding $100 million and 498 AI unicorns valued more than $1 billion each. Most of these companies aren't profitable. In reality, 70% of funded AI startups are still losing money, but their valuations persist climbing because everyone's apprehensive of missing out. You understand what we designate that in Omaha gambling. Charlie Munger, God rest his soul, used to inform me, Warren, it's waiting that assists you as an investor, and numerous people just can't tolerate to wait. Charlie comprehended something that most people on Wall Street never learn. Making money in the stock market is about patience, not activity. Right now, I observe companies expending 22% to 30% of their revenue on capital expenditures, money they're investing in AI infrastructure. That's 3 times what utility companies expend, and utilities actually possess predictable cash flows. Meta's planning a data center that would require over 2 gigawatts of power. That's sufficient electricity to power a small city, just to house 1.3 million NVIDIA GPUs. And I have to inquire for what? To train AI models that might be obsolete in 2 years, to compete in a race where everyone's expending billions to maybe, possibly, hopefully generate returns sometime in the distant future. This isn't investing. This is speculation on steroids. The uncomfortable truth that nobody wants to hear is this: for all this spending to compensate, AI companies need to generate $2 trillion in annual revenue by 2030. Right now, they're generating approximately $20 billion. That's a 100-fold increase in 5 years, not a 100% increase, a 100-fold increase. I've been in this business since 1951. I've never, and I mean never, witnessed an industry scale that rapidly while maintaining profitability. It defies the laws of business gravity. Let me inform you something about numbers. They're stubborn elements. You can dress them up, apply cosmetics to them, designate them adjusted EBITDA or AI, adjusted revenue, but at the end of the day, a business either generates money or it doesn't, and right now the numbers in AI don't accumulate. Microsoft, Amazon, Google, and Meta are projected to expend a combined $364 billion in their 2025 fiscal years. These aren't startup companies gambling with venture capital. These are the largest, most profitable corporations in the history of capitalism, and they're expending money like intoxicated sailors on shore leave. Microsoft just elevated its capital expenditure guidance to over $120 billion for 2025. Amazon expending $100 billion. Google increased its forecast from $75 billion to $85 billion. Meta's at $70 to $72 billion and announced they expect similarly significant capex dollar growth in 2026. Now, I want you to comprehend what these numbers signify in real terms. Microsoft's $120 billion in capital spending is 7 times what they expended just 5 years ago. 7 times. That's not growth. That's a complete transformation of their business model. And they're wagering the farm that it functions. But here's where it becomes interesting. Despite all this spending, AI-related revenue remains a tiny fraction of their total business. Microsoft reported that their AI services had achieved a $13 billion annual run rate. That sounds impressive until you realize they're expending $120 billion to generate a $13 billion in revenue. That's like expending 9 all to make 1. But Warren, you might state this is about the future. They're investing for long-term gains. And you're correct, it is about the future. But there's investing for the future, and then there's speculation. The difference is straightforward. Can you reasonably predict the return on that investment? In the dot-com era, companies like Global Crossing expended $15 billion constructing a worldwide fiber optic network. The logic was impeccable. Internet traffic was doubling every 100 days, so we'd need massive capacity, except they overbuilt by 99%. When the music stopped, $15 billion in investment was valued pennies on the dollar. Today's AI infrastructure build-out is occurring even faster and at an even larger scale. The parallel isn't just similar, it's practically identical. And here's something that should terrify anyone who comprehends market history. This spending is being funded increasingly by debt. Meta just arranged $27 billion in off-balance sheet financing. These companies are assuming leverage at the same time they're executing massive, uncertain wagers on technology that might not compensate for years, if ever. I've lived through sufficient credit cycles to understand that debt magnifies everything, both gains and losses. When things are progressing well, debt makes you wealthy faster. But when things reverse, debt is what eliminates you. Remember, in my early days, I executed the error of purchasing Berkshire Hathaway itself because I was angry at management. It was a cigar butt stock, cheap enough that I thought I could obtain one more puff out of it. That investment, which I executed out of emotion rather than reason, probably cost me $200 billion in opportunity cost over the years. It's the worst investment decision I ever executed. And I've expended decades attempting to explain to people why purchasing a struggling textile company was such a monumental error. The lesson: even intelligent people execute unintelligent decisions when they permit emotion to override analysis. And right now, the emotion in AI investing is fear. Fear of missing out, fear of being left behind, fear that if you don't invest billions immediately, your company will become irrelevant. That's not a recipe for quality capital allocation. That's panic dressed up as strategy. Let me provide you some more uncomfortable numbers. OpenAI, the poster child of the AI revolution, is on track to lose several billion dollars this year, despite ChatGPT's popularity, despite partnerships with Microsoft, despite a $500 billion valuation. They're hemorrhaging cash. Their costs are so high that they need to continually elevate prices while simultaneously attempting to reduce the computational expense of their models. And they're not alone. The entire AI startup ecosystem is constructed on the assumption that eventually, someday, these models will become profitable. But here's what history teaches us: eventually often never arrives. In the dot-com era, we possessed something designated the burn rate, how rapidly a company was expending its cash reserves. Analysts would calculate how many months of runway a startup possessed before it ran out of money. Today, we're witnessing the same thing with AI companies. The difference is that now they possess deeper pockets backing them, so the burn continue longer. But the fundamental problem hasn't changed. Spending more than you generate is not a sustainable business model. Ray Dalio recently stated that he observes bubble conditions forming, but that bubbles don't pop until monetary policy tightens. He's correct about that. The Federal Reserve's interest rate policy has been accommodative, making capital inexpensive and easy to access. But what occurs when interest rates need to elevate again, or when the economy slows and investors commence demanding profits instead of promises? That's when we'll observe who's swimming naked, as I prefer to state. And right now, I suspect there are numerous naked swimmers in the AI pool. Here's another parallel that keeps me awake at night: market concentration. At the peak of the dot-com bubble, the top 10 stocks constituted approximately 27% of the S&P 500's total weight. Today, the top 10 stocks represent 39% of the index. That's not just concentration, that's dangerous concentration. Or more likely, when these stocks correct, they won't just drag down the technology sector, transport the entire market with them. Your 401k, your pension fund, your index funds, they're all loaded up with these identical companies. The average investor thinks they're diversified because they possess an S&P 500 index fund, but they're really executing a massive wager on 10 companies, most of which are expending unsustainable amounts on AI infrastructure. And here's the element that genuinely bothers me. We understand how the story concludes because we've witnessed it before. After the dot-com crash, it required the NASDAQ 15 years to return to its March 2000 peak. An entire generation of investors learned the difficult way that trees don't grow to the sky. But the most concerning aspect isn't the spending, it's the revenue gap. According to recent research, big tech has invested approximately $60 billion in AI infrastructure over the past 2 years. The combined AI-related revenue from Microsoft, Meta, Tesla, Amazon, and Google, approximately $35 billion. That's a 16:1 ratio of spending to revenue. Now, I'm not a mathematics genius, but I understand that you can't expend 16 to make $1 and designate it a quality business. Some of this spending will compensate eventually, certainly, but not a chance. MIT recently conducted a study that discovered 95% of AI pilot projects fail to yield meaningful results, 95%. That's despite more than $40 billion in generative AI investment. The gap between the hype and the reality is wider than the Grand Canyon. What genuinely concerns me is the psychology behind all this spending. It's not based on careful analysis of returns. It's based on fear. Fear that if you don't invest now, you'll be left behind. That's the identical psychology that drove the dot-com bubble, the housing bubble, and every other bubble in history. In my 2000 shareholder letter, I wrote about how investors were like Cinderella at the ball. They understood that remaining too long would transform everything to pumpkins and mice, but they detested to miss a single minute of the party. Today, we're witnessing the exact identical behavior, just with artificial intelligence instead of the internet. The party's in full swing right now. The music's playing, the champagne's flowing, and everyone's possessing a great time. But I've attended sufficient parties to understand that they all conclude the same way, with someone stuck with the cleanup bill. You understand, people often inquire me what the secret to successful invest. They expect some complicated formula, some sophisticated algorithm, but the answer is simpler than they think. Don't lose money. That's rule number one. Rule number two is don't forget rule number one. It sounds simplistic, but think about what it genuinely signifies. If you lose 50% of your money, you need a 100% gain just to return to even. That's not a game you want to participate in. And right now, with AI valuations where they are, I observe numerous people participating in that exact game. Let me inform you about a study I encountered recently. A researcher named Kai Wu examined major capital expenditure cycles throughout history: railroads in the 1860s, automobiles in the 1900s, radio in the 1900s and 1920s, the internet in the 1990s. You understand what he discovered. In every single case, the companies that aggressively grew their balance sheets through massive capital spending underperformed conservative peers by an average of 8.4% annually. Let me state that again. The aggressive spenders lost to the conservative companies by 8.4% per year over a decade. That difference compounds to a massive underperformance. The patient investor defeats the aggressive spender almost every single time. Why does this occur? It's not complicated. When companies race to construct capacity, whether it's railroad tracks, fiber optic cables, or AI data centers, they create massive overcapacity. Supply exceeds demand. Prices fall, returns evaporate, and investors are left holding the bag. Right now, we're witnessing the exact identical pattern. Companies are constructing AI infrastructure at an unprecedented pace, all wagering that demand will be there to justify the investment. But what if it's not? What if AI adoption is slower than everyone thinks? What if newer, more efficient technologies make current investments obsolete? I learned a valuable lesson from my mentor, Ben Graham. He taught me about the margin of safety, the idea that you should only invest when the price is significantly below the intrinsic value, providing you a cushion against mistakes or bad luck. Today's AI valuations possess no margin of safety. They assume everything proceeds correctly. Perfect execution, continued technological progress, unlimited demand, no competition, no disruption. In my 70 years of investing, I've learned that everything rarely proceeds correctly. Usually something proceeds incorrectly. Sometimes everything proceeds incorrectly. That's why you need a margin of safety. Let me provide you a concrete example of what I'm discussing. Cisco Systems was the darling of the dot-com era, the picks and shovels of the internet revolution. At its peak in March 2000, Cisco possessed a market cap of $555 billion, making it briefly the most valuable company in the world, to sales ratio of 35 and a PE ratio above 200. Everyone stated Cisco was different. It possessed real revenue, real profits. It wasn't some pie in the sky startup, and they were correct. Cisco was different, survived the crash. But the stock, it fell 86% from its peak. Even today, 25 years later, Cisco trades below its 2000 high. Think about that. If you purchased Cisco at the top of the market thinking you were investing in a solid, profitable technology leader, you'd still be underwater a quarter century later. That's not even accounting for inflation. Now observe NVIDIA. It's trading at a $5 trillion market cap. Is NVIDIA a quality company? Absolutely. Is it revolutionizing computing? Yes. Does it possess real revenue and real profits? Yes to both. But is it valued $5 trillion? That's where I possess my doubts. For that valuation to establish sense, everything has to proceed perfectly. AI demand has to continue growing exponentially. No competitive threats can emerge. The company has to maintain its pricing power. Technological changes can't obsolete current chip designs. The global economy has to remain strong. That's numerous things that all have to proceed correctly. And in my experience, when you need everything to proceed correctly, something usually proceeds incorrectly. Charlie Munger used to inform me, all I want to understand is where I'm going to die. So I'll never go there. He was discussing avoiding obvious errors. And the most obvious error in investing is compensating too much for an asset. No matter how quality that asset is, I could purchase the best house in America, but if I compensate 10 times what it's valued, it's a poor investment. The identical principle applies to stocks. Price matters. Valuation matters. The enthusiasm of the crowd doesn't alter the fundamental mathematics of value. Right now, the crowd is very enthusiastic about AI, and I comprehend why. AI is impressive. It will transform the world. But so did the internet, and that didn't prevent the dot-com crash from wiping out trillions in wealth. Here's something most people don't realize. Even if you're correct about the technology, you can still lose money if you compensate too much. I was incorrect about the internet's impact. It transformed the world more than even the optimists predicted. But if you purchased the NASDAQ at its peak, you lost money for 15 years. Even though the internet transformed society, being correct about the future and generating money in the stock market are two different things. The difference is the pre-error price you compensate. Let me inform you about another historical parallel that's been on my mind. In the 1920s, there was enormous enthusiasm about radio. It was revolutionary technology. For the first time, you could transmit information through the air. Radio stock soared. Everyone wanted in. RCA witnessed its stock rise from 85 in 1928 to a peak of 549 in 1929. Then came the crash. By 1932, RCA had fallen to 18. It required 27 years for RCA to return to its 1929 high. Radio did transform the world. The technology was revolutionary. The early investors were correct about the impact, but they compensated prices that couldn't be justified by any reasonable projection of earnings. And they compensated for that error with decades of underperformance. Today, I observe the identical pattern. Investors are compensating extraordinary prices because they believe AI will transform everything. They're probably correct that AI will transform everything. but that doesn't signify current prices' established sense. One of the most valuable lessons I've learned is that the stock market is a voting machine in the short term, but a weighing machine in the long term. Right now, the vote is strongly in favor of AI stocks, but eventually the market will weigh these companies, measure their actual earnings, their return on capital, their competitive position. And when that weighing occurs, I suspect many current valuations will be discovered wanting. The other element that concerns me is the game theory problem these companies face. If Microsoft stops expending on AI, they risk falling behind Google. If Google slows down, they risk losing to Amazon. So everyone keeps expending, even though collectively they're probably overbuilding capacity. It's a prisoner's dilemma, and nobody wants to be the first to blink. But someone always blinks eventually. Maybe it's an economic slowdown that forces capital discipline. Maybe it's a new technology that makes current investments obsolete. Maybe it's simply investors demanding profitability instead of growth at any cost. Whatever triggers it, the dynamics will alter. And when they do, the stocks that have been bid up to unsustainable levels will return down to earth. It occurred with railroads, radio, electronics, biotechnology, the internet, and it will occur with AI. I don't understand when nobody does. Anyone who informs you, they can time the market is lying to you or to themselves. But I understand it will occur because it always occurs. Bubbles always pop. Gravity always wins. The question isn't whether there will be a correction. The question is whether you'll be positioned to survive it and perhaps even benefit from it. So where does that leave us? Look, I'm not stating AI is worthless. I'm not stating these companies won't succeed. What I'm stating is the current valuations embed expectations that are almost impossible to meet. And when you compensate prices that require perfection, you're setting yourself up for disappointment. My approach hasn't altered in 70 years, and it won't alter now. I invest in businesses I comprehend at prices that establish sense with a margin of safety. Right now, AI stocks meet exactly none of those criteria for me. Can I prove I'm correct? No. Maybe this occasion genuinely is different. Maybe AI will grow rapidly enough to justify current valuations. Maybe every one of these massive capital expenditures will generate appropriate returns. It's possible. But I'm 95 years old, and I've heard this time is different more times than I can count. And every single time, it wasn't different. The fundamental laws of economics and human nature don't alter just because the technology does. Here's what I understand with absolute certainty. If you lose 50% of your money, you need a 100% return to break even. That's mathematics, not opinion. So my first goal is always capital preservation. Right now, the safest thing Berkshire can do is what we're doing, sitting on over $300 billion in cash and short-term securities. People criticize me for not putting that money to work. They state I'm missing opportunities. Maybe I am. But I sleep well at night, understanding that when this market corrects, and it will correct, Berkshire will possess the capital to take advantage of the opportunities that emerge. We'll be able to purchase wonderful companies at fair prices when others are forced to sell. That's not exciting. It won't get me on CNBC, but it's what has functioned for me for 7 decades, and I observe no reason to alter now. The AI revolution is genuine. The bubble is also genuine. Both elements can be true at the same time. Your job as an investor is not to predict which AI company will win. Your job is to protect your capital and position yourself to profit regardless of what occurs. And right now, the best way to do that is to be patient, be selective, and be willing to sit on cash when you can't locate investments that meet your criteria. As I've stated before, the stock market is designed to transfer money from the active to the patient. Right now, there's considerable activity. There's not much patience. I understand which side of that equation I want to be on. The AI bubble will burst. I don't understand when, and I don't understand what will trigger it. But I understand it will occur because every bubble in history has burst. And when it does, you'll be glad you listened to an old man from Omaha who's witnessed this movie before. Stay safe out there. Look, I'll conclude with this 25 years ago. People designated me a dinosaur for not investing in internet stocks. They stated I didn't comprehend the new economy. They stated I was too old, too conservative, too stuck in the past. Then the market crashed and Berkshire's stock price doubled while the Nasdaq lost 78% of its value. Suddenly, I wasn't a dinosaur anymore. I was a genius. But I didn't alter. The market did. The identical element is about to occur with AI right now. I'm the old man who doesn't comprehend artificial intelligence, the skeptic who's missing the biggest opportunity of the century, the cautious investor who's being left behind. That's fine. I've been designated worse. But in a few years, maybe sooner, maybe later, we'll look back at 2025 the identical way we look back at 1999. We'll shake our heads and wonder how people compensated such crazy prices. We'll marvel at the speculation, the circular financing, the irrational exuberance. And the investors who preserved their capital, who stayed patient, who refused to get caught up in the mania, they'll be the ones positioned to profit from the opportunities that emerge from the wreckage. That's where I plan to be. I hope you'll join me there. Thank you and God bless.